Good morning, everyone. Welcome to today's dairy webinar. My name is Matt Davis, and I'm Vice President, Food and Agribusiness, specializing in dairy here for Farm Credit Mid-America. We're a financial services cooperative serving 80,000 customers in Indiana, Ohio, Kentucky, and Tennessee. Thanks for being with us this morning. Because we work closely with dairy producers across our 4 states, we know many of the challenges and opportunities that we are experiencing today in our industry. In addition to having the financial strength to work alongside our customers, we also have access to leaders like those that you'll hear from today. We hope the webinar is useful in providing information about what's happening in our marketplace, and you find information that helps with the decisions you're making on your farms. So today we are bringing you 2 experts to speak to the current dairy markets and conditions associated and opportunities associated with the opportunities that present themselves to us. We know it's a busy time for our presenters, and we thank them for taking time to share their insights and experience with us today. Now, before I transition over to our speakers, I want to reiterate that this webinar is intended for the audience on today's call for informational purposes only. It is not for public or media consumption. Any opinions expressed by the presenters are their own and do not necessarily reflect those of Farm Credit Mid-America. Now first, I'm going to introduce you to Nate Dene. Nate is Director of Dairy Market Insight at INTL FC Stone and has been applying his interest in large, complicated systems and statistical analysis to the international and U.S. dairy market since 2005. As a consultant, he's worked with clients at all levels of the dairy marketing chain, from the farm level up to processors and packaged food companies, food distributors, and restaurants, as well as connected industries like banks, private equity groups, government agencies, and industry associations. Through ongoing reports and one-off client-specific projects, he helps them understand the short and long-term trends and underlying relationships driving the market and what that means to their businesses. Nate, thanks for being with us this morning.
Thank you, Matt. So along with that, our legal group wants me to have our disclaimer up here for 30 seconds, so I'm going to time it. We're going to have it up here for exactly 30 seconds, and then we'll move on. If I'd known you were going to read the whole bio, I would have given you a shorter version. Usually when people ask me what I do, I say that I track, model, and forecast the supply, demand, and prices of dairy products around the world. And usually when we see a big move in the U.S. dairy market, it's typically driven by the global supply and demand of dairy products, not necessarily the domestic fundamentals at the time. But the last 3 months have been almost purely domestically driven, especially on the rebound that we've had. We've become disconnected from the world market. Now, this graph shows our calculated manufacturing milk prices across the major dairy exporters. The major exporters are Oceania, which is primarily New Zealand at this time, the EU, and the US. And the way to think about these prices is that they're like the average Class 3, Class 4 milk price, except they also include the value of whole milk powder for Europe and Oceania. So you can see, over time, U.S. pricing, the blue line, is pretty well correlated with the other lines. And we saw prices everywhere start to slump this spring as the pandemic got a bigger foothold in the U.S. and the EU and other parts of the world. But the rebound that we've seen in U.S. prices is head and shoulders above the rebounds that we've seen anywhere else in the world. And frankly, we're all scratching our heads a bit trying to figure out exactly what is driving the rebound in U.S. prices. As prices were collapsing back in March and April, I did a lot of analysis around how much dairy is contained in the average food service meal, how much dairy is contained in the average homemade meal, how is total dairy demand going to be impacted by people shifting from food service to homemade? And the answer is it's a negative impact for dairy demand. And then we were entering into the worst recession since the Great Depression. We're talking about tens of millions of people unemployed. Looking back and doing the modeling around how these macroeconomic issues factor into total dairy demand, the conclusion was it was negative for dairy demand as well. So the expectation by myself, my team, other dairy forecasters and analysts that I listened to, everybody thought pricing was going to stay low for quite a while. It was going to take some time for the supply side to adjust and demand eventually to come back and prices to eventually rally. Instead, the market turned around on a dime and we pushed CME block cheese up to new record highs here in the past couple of weeks. So it's been a surprise. The supply side has factored into it. U.S. farmers are the only ones out of the major dairy exporters who have made large and quick adjustments to milk production. So there is a supply side story here, which we'll get to. But first, I do want to talk about the demand side, because demand has turned out better than expected in the past 2 months. And when I sit down and try to figure out why that demand has been as good as it has been, I think a big part of it is government money. This data here came out last Friday. It's real personal income, and the chart is showing the year-over-year percentage change in real personal income. Real personal income for April was up 11% from a year ago. That is fantastic growth. In the first quarter, we averaged just 1% growth in real personal income. However, if you remove government transfer payments, these are things like the $1,200 stimulus check that went out in April, the increased unemployment benefits, the expanded SNAP or food stamp benefits. If you remove those things, which are classified as government transfer payments, then real personal income was actually down 7%. So in terms of what this economy is generating on its own, income's down 7%, but thanks to government transfer payments, real income is actually up 11%. So the government is doing a fantastic job of cushioning the blow of the pandemic for consumers, or at least they were through April. Another example of this is those $600 federal unemployment benefits, $600 per week. Typically, the unemployment insurance is handled at a state level. Each state has their own rules about qualifying for unemployment, as well as how much they're going to pay out. But in one of the stimulus packages, I forget which one, Congress has passed a few of them, they added in an extra $600 per week payment from the federal government for those who are unemployed. And there's been a number of different studies on this, but our recent one here is estimating that 68% of those people who are unemployed are receiving more in unemployment benefits than they were in wages from their job. I don't want to underplay or dismiss the real economic pain that many people are feeling. And, you know, the $1,200 stimulus check was so far a one-off. These unemployment benefits are slated to run out at the end of July. And so we're facing the potential for a lot more damage to consumer confidence and consumer incomes moving forward. So I don't want to gloss over that. But in terms of how did dairy demand play out in April and May and now into June, how are things this good? I think a big part of the explanation is that the U.S. consumer has been pretty well insulated from the negative impacts to the macroeconomy from the pandemic so far. The other way that government money is playing into the strength in dairy prices is with the direct purchase of dairy products by the USDA, or by them paying contractors to procure dairy products and deliver them directly to consumers like they're doing with the food box program. Early this year, the USDA was only buying about $10 million worth of dairy products per month. Now they've stepped up to purchases in the range of $100 to $200 million per month. They're using money from 4 different pools of money. They have funds from what they call the Section 32 program. They have funds that were allocated by the Families First Coronavirus Act and CARES Act. They still have money left over from trade mitigation funds. And then they also have this food box program. So there's a number of different programs that they're drawing money from to purchase these dairy products. And at the current pace, at the pace that they're buying in June and July and August, they're buying about 2 to 3% of total U.S. milk production. So these are significant purchases in terms of tipping the supply and demand balance. The concern moving forward is that eventually these programs are going to run out of money. So far, through August, maybe into September, there's still quite a bit of money there that can be spent. The purchases will probably stay strong. We did see the purchases slow down a bit with cheese prices at record highs. And then last Thursday, the USDA put out a solicitation to buy another 8 million pounds of mozzarella using Section 32 funds. 8 million pounds of cheese is not a big market mover on its own, but the fact that the USDA was still stepping out there and buying more cheese despite the fact that the market was at a record high indicates that they're really not concerned with the price level, and they're going to keep spending the money as we move forward here. So short term, through August, maybe into September, we're looking at some fairly strong direct purchases of dairy products by the USDA that's going to be supportive for the market. But with the money that's been allocated so far, those funds start to run out, start to slow down the purchases October, November, December forward. Now, Congress is considering another stimulus bill. There could be more money added for support to agriculture, which could result in continued large purchases by the government. They could send out another stimulus check to consumers. They could extend the unemployment benefits further into the calendar year. It is an election year. I think both sides would like consumers to be feeling pretty good in the lead up to the election, or at least they would like to be able to take credit for consumers feeling pretty good in the lead up to the election. And this Congress administration has had no problem spending trillions of dollars so far. So I think there's pretty good odds that we will see some type of stimulus bill that consumers will be decently insulated from the negative macroeconomic impacts, but eventually the purchases are going to slow down and the payments to consumers are going to slow. So then the question becomes, what does real underlying commercial demand look like right now and moving forward? This graph in the upper left-hand corner with the bars there, blue bars and gold bars. The blue bars are the year-over-year percentage change in retail dairy sales, and they're positive, although the retail sales growth is slowing down. The gold bars are food service sales in dollar terms, and they were sharply negative, but they're moving back towards year-ago levels. Retail sales right now are up about 10% from a year ago on a volume basis. Food service sales are still down 20 to 25%. But what we don't know on food service sales, all we know is the dollars moving through food service. We don't know the volumes moving through food service. And I believe that food service meals have become more dairy heavy since the lockdowns began. The strongest evidence for that is the very strong sales that the pizza chains are seeing. Domino's same-store sales were up 14% from a year ago in April and May. Papa John's was up 30%. Pizza Hut wasn't so hot. They rely more on in-person dining, but even Pizza Hut, I believe, was up about 4%, at least for their locations that were currently open. And so even though the headline number, food service sales, still down 20% from a year ago, the amount of cheese that is moving through food service, it has to be down less than 20%, and it may be close to year-ago levels. So we have to be a little bit careful about that headline food service number. It's not directly connected to the amount of dairy that's moving through food service. So that's a good thing. Dairy demand is probably doing a little bit better than those headline numbers would make you think. So all of these numbers on the demand side, it is very confusing. I've done my best here to roll all of it up into a single total dairy demand number, looking at how retail is doing, how food service is doing, factoring in less product moving through the schools, more product moving through packaged goods, frozen pizzas. If you sit back and you look at the number of things on grocery store shelves that contain dairy, I mean, salad dressings, all of those cake mixes and pancake mixes and granola bars and nutritional bars, and all of these things have dairy in it, but it's not necessarily captured by dairy retail sales, right? All of that stuff is packaged goods. And so if we try to factor in the stronger sales that we're seeing in packaged goods, mac and cheese, there's another one, mac and cheese off the shelf. Try to roll all of that together along with the government purchases to get an idea of how is dairy demand right now and what does it look like going forward. If I roll it all together, I think we're looking at total dairy demand that's up from last year during June. I was working through these numbers and the methodology that we're using to create this index for 2 or 3 hours yesterday, and the number I was coming out with was a little bit lower than this. But either way, right now, I think total dairy demand, including the government purchases, is up. But if you net out the government purchases, without government purchases, I think the total dairy demand is still running below year-ago levels. So it kind of goes back to that first graph that I showed on real income. If you include the transfers from the government, consumers are doing great. If you remove those transfers, it doesn't look so positive. And moving forward, those government purchases start to slow down, and we're going to move from something like 3% total dairy demand to 1 to 2% type growth, July and August, I believe. So we're probably at peak gains in terms of year-over-year percentage gains on the demand side right now. So the next question becomes, how does that line up with supply? And when I'm talking about supply, whether it's in the U.S. or internationally, I always start with our estimated margins for that country or region. And farm gate margins in the U.S. collapsed this spring, along with dairy prices and milk prices. But they've turned around dramatically. We now have Class 3 milk for June that's going to be around $21 a hundredweight. July is going to be somewhere between $20 and $22 a hundredweight. Farm gate margins have made a massive recovery, at least short term. Now, my forecasted margin going forward is based off of my milk price forecasts, which are more bearish than the futures. If you look at this based on the futures, margins don't drop as much as what I'm showing here for the second half of the year. So the market is telling farmers to boost production. There's that collapse in pricing early this year was traumatic. I don't think farmers are going to be as willing to expand as they have been in the past, but $20, $22 milk is going to drive some expansion in production. I should explain the format of this chart. The gold line across the top there is milk production adjusted to a 30-day basis. And I have that on the graph so that you can see the seasonality, you can see the underlying trend. But the blue bars show the year-over-year percentage change, which is usually what we're talking about when we're talking about dairy fundamentals. And the blue bars there, you can see in March, we were at just about 3% growth for year-over-year gains in milk production. That slowed to a 1.1% drop by May. I'm not quite sure if that's a record slowdown, but that is a near record slowdown in milk production. Cooperatives and milk buyers put into place their base over base pricing systems in April, and farmers responded with some large cuts. Now, the cuts were mostly in production per cow, reducing from milking 3 times a day or 4 times a day to twice a day, adjustments to rations, drying out some cows early. We did see a brief jump in terms of dairy cow slaughter, and the size of the dairy herd is dropping off a little bit here, but it's still above year ago, and it's probably going to remain above year ago. In the past 6 weeks, the dairy cow slaughter has dropped back below year ago levels. And so the adjustments that were made were more temporary in nature. It's not a mass culling. Some of the milk buyers and cooperatives have removed their base over base programs, and the market is now telling farmers to expand production. And so we're probably still negative. Milk production is probably still down from year ago levels in June. July is going to be close. I'm not sure. It depends on how quickly we can turn the milk back on. Some farmers tell us it's going to take a little while to turn the milk back on. Others say it'll come back pretty quick. So I'm not quite sure. Right now, I have July milk production slightly above year-ago levels. But if you think back to the demand graph, if we have demand up 3% from a year ago during June, and we have production that's still down from a year ago, that's a big gap, and that's been very supportive for pricing. As we move into July, we end up with a demand side that's up 1 to 2%. Milk production still not growing at 1 to 2%, so we're still pretty well supported for pricing in July. But as we transition into August, September, the government starts to run out of money for purchasing dairy products. Maybe the consumers aren't feeling as good. This 1 to 1.5% growth in milk production starts to line up with the demand side, or even might be running a little bit higher than the demand side. So short term, the weak milk production is supportive on pricing, but the cuts to milk production have been temporary in nature, and with cooperatives and milk buyers removing their base programs early and the market at the price levels that we're at, we're going to get a response on the supply side. So in June, we're probably at the peak in terms of year-over-year growth on the demand side, and we're probably at the trough in terms of year-over-year declines on the supply side. The fundamentals start to trend more bearish on both the supply and the demand side from June forward. At least that's the current expectation. Now, I did include one graph on inventory levels. Again, the same format as the last chart. The gold line there is actual inventory level attached to the right-hand axis, and the blue bars are year-over-year percentage change. So we came into this year with milk equivalent inventories down from the prior year, and by April, stocks were up about 12–13% from year-ago levels. But the most recent data point that we have is April. Milk production growth has slowed down and went negative since then. The demand side has turned out better than expected. We're going to draw down those inventories. I'm not overly concerned about the inventory levels being real damaging to price levels later this year. Now, we have disconnected from the world market, but we still need to keep an eye on it. It would have the potential, maybe things turn out much more bullish than expected on the world market. Market prices rally up and create a floor underneath the U.S., and maybe we won't fall back that much. I mean, it's possible, but I don't think that's the way things play out. When I look at margins, the graph in the upper left-hand corner, these are margins across the major dairy exporters weighted by their milk production. Farm gate margins in Europe and New Zealand have pulled back as well. First quarter was very, very good, but we're kind of back to break-even type price levels here for the remainder of 2020. They're not horrible margins. They're not the levels that are going to result in a big cut to milk production. And so far, the U.S. is the only place where we've seen a coordinated effort to reduce milk production short term. Elsewhere, they've mostly continued to produce along normal lines. So milk production growth, the right-hand upper graph, milk production growth across the major dairy exporters has slowed down a bit. Europe was getting a bit dry in terms of weather. They've gotten some rain over the last 2 weeks. They're bouncing back a bit. New Zealand was dry. They're bouncing back a little bit. We've slowed milk production growth from where we were in the first quarter, but it still looks like across the major dairy exporters, we're looking at something like 1% growth through the third quarter. Now, my models are saying that we'll see a slowdown in European milk production growth in the fourth quarter and early 2021, thanks to the level that margins are at. Our team in Dublin doesn't think so. The general feeling in Europe is that their milk production will stay above year-ago levels. So if I'm wrong about the production forecast, I think production will turn out higher than forecast Q4, Q1. So overall, the supply side globally doesn't look overly bullish or overly bearish. It just, we've slowed down from where we were in the first quarter, but we're still talking about moderate growth around 1%. Then the question is, what does global demand look like? The graph in the lower left-hand corner is global milk equivalent imports on a 12-month rolling basis. And it did pop a little bit higher for April, but in general, global imports have been about flat since October or November of last year. There's no strong uptrend there. You know, even before the pandemic had a massive impact on the global economy, there were concerns about the pandemic and its spread in China. Dairy prices were relatively high in late 2019. That was damaging the short-term demand side as well. So the recent demand numbers, not overly strong. And right now the models are saying global demand's not going to look all that good. So far, big government stimulus has supported consumers in the US, Europe, Canada, and some of the other developed countries. But when I dig into the stimulus packages that we're seeing in countries like Vietnam or Indonesia or Thailand or Algeria or Saudi Arabia, those governments are not spending to the same degree that that the U.S. has been. And so they're not cushioning the blow to consumers the way we have in the U.S. And in fact, the IMF updated their GDP forecast here yesterday, and they revised these numbers down even further. So if you look at the lower right-hand corner, developing country real GDP growth, the IMF is forecasting GDP is going to be down in developing countries in 2020. Compare that to 2009. You know, there was a massive slowdown in GDP growth for developing countries in 2009, but it was still positive growth. We're looking at an even harsher impact to consumers financially in 2020 than we saw in 2009. So the demand outlook does not look too good. Even with that 1% growth in milk production across the major dairy exporters, it looks bearish. It looks like too much milk coming out of the major exporters for these importing countries to absorb at current price levels. So I think the amount of time we're going to spend here at $20 plus Class 3 is pretty limited. We should see something around $21 Class 3 for June. July, somewhere in the range of $20 to $22 a hundredweight, depends on what happens with the cheese market here in the next week or two. But then we start shifting down towards $16 type pricing for Class 3 milk. And that's horrible compared to $20 milk, but you have to remember that we are in the worst recession since the Great Depression. And $16 milk during the worst recession since the Great Depression isn't all that bad. But you look at the supply side, cooperatives and milk buyers have removed the base over base programs, and the market is telling farmers to produce more milk, right? The supply side is going to improve from current levels unless we put into place new base over base programs. The demand side has been better than expected, but it looks like it's being primarily driven by government money, both supporting the U.S. consumer as well as directly purchasing dairy products. Now, we have to remain aware that more money could be allocated to these programs. The demand side could stay stronger than expected with continued infusions of government money, so we can't say absolutely that the demand side is going to slow down, but odds are that the demand side is going to slow down when some of this government money runs out. So I think we have to be defensive in terms of looking forward and expect prices to adjust down from current levels. $16 milk isn't horrible. And again, it's $16 milk during the worst recession since the Great Depression, which we have to be somewhat grateful for. But I don't think the $20 Class 3 milk is going to last. With that, I'll pass it back to you, Matt.
Nate, thanks a lot for that synopsis of the current dairy market situation. It really gives us some good perspective coming around and amidst all of this unprecedented volatility that we've seen here in 2020. So thanks for sharing. Next, I'd like to introduce you to Sterling Watkins. He's a crop insurance specialist here at Farm Credit Mid-America. His background prior to Farm Credit includes 30 years of management and sales experience in the food service industry. Approximately 10 years ago, he chose to pursue a career in agriculture. He grew up on a small dairy in Leesburg, Indiana, and the life lessons learned on the farm and relationships developed brought him back to his roots. He began his journey here at Farm Credit and he's worked in the risk management segment of our business since 2011. He and his wife, Sarah, of 35 years, live in Warsaw, Indiana, and they raised a wonderful daughter, Maggie, who's starting a career of her own at present. So, Sterling, thanks for being here.
Thank you very much, Matt. That was very insightful. Yeah, that's a hard act to follow. I wish now I would have went first. But, well, good morning. As Matt said, my name is Sterling Watkins, Farm Credit Mid-America. Our purpose at Farm Credit is to secure the future of rural agricultural communities. My purpose with Farm Credit is to help grain and livestock producers mitigate risk and make more money. I chose to offer Dairy Revenue Protection, or DRP, as it is commonly referred to, when it was first introduced in October 2018, because I believed, and I continue to believe, it is a valuable and beneficial risk management tool for dairy producers. Dairy producers throughout the U.S. are leveraging this risk management tool for the 2020 insurance year, as illustrated by the fact that over 56 billion pounds of milk have been insured as of May 20th, 2020. This represents approximately a 190% increase over the same time period compared to the 2019 insurance year. Dairy Revenue Protection is administered by the Federal Crop Insurance Corporation in partnership with private sector insurance companies and agencies such as Farm Credit Mid-America. Dairy Margin Coverage, or DMC, which is administered by the Farm Service Agency, may, and in my opinion, should be used in conjunction with DRP to mitigate risk. DRP is a revenue-based policy which mitigates the risk of yield and/or price declines. Dairy margin coverage is a margin-based policy which allows a producer to effectively insure up to 5 million pounds of production annually to protect the difference between the all milk price and the average feed price. The utilization and the projected benefits depicted on this slide favor dairy revenue protection over dairy margin coverage. There are currently proposals being discussed to enhance the dairy margin coverage program, and it's my hope for the dairy industry's sake that the DMC program is improved. Dairy revenue protection is not based on the milk prices you receive personally from the milk processor, but rather the Class 3 and Class 4 futures prices compared to actual prices based on the Chicago Mercantile Exchange. Based on my experience working with this plan of insurance, the CME prices generally reflect the prices dairy producers receive on their farms. Whereas you may insure milk commodities with this plan of insurance, I will focus only on Class 3 and Class 4 milk today. I will be utilizing 95% coverage levels and 10 million pounds of declared covered milk production throughout the presentation. Note that you can insure up to 100% of your expected milk production. It will benefit you to understand how you arrive at your guaranteed revenue levels. First, we're going to multiply the quoted price of $16 per hundredweight times 95% coverage level to arrive at a guaranteed price of $15.20 per hundredweight. Next, multiply $15.20 times 10 million pounds of insured milk and divide that by 100 to arrive at $1,520,000 of guaranteed revenue or liability. This formula represents the price component aspect of the revenue safety net. Later, when I discuss indemnity payments, I will introduce the yield component aspect of dairy revenue protection. The sales season for DRP is July 1 through June 30. We are currently in the 2020 crop season. Effective July 1, 2020, we will enter the 2021 season. In the first column, under the subheading Sales Dates, 5 rows down, you can see we are in the June 16 to June 30 timeframe. Thus, moving to the right 5 columns to the green highlighted number 805, you can see insurance endorsements are available for the fourth quarter 2020, October through December, and then moving forward as far out as the third quarter, July through September of 2021, highlighted by the green number 808. It is important to note that generally, not always, but generally, premiums for the nearby quarters are less expensive than the further out quarters. I will circle back to this in a moment when I discuss the benefits of layering endorsements on top of each other, as premiums again generally decrease in conjunction with the potential of increased futures prices. I believe the class pricing option is the most beneficial, efficient, and succinct method for mitigating risk while also increasing your revenue. I base this on my research and knowledge of this risk management tool, as well as actual loss ratios experienced by our existing customers. As mentioned previously, daily endorsement price quotes are based on the Chicago Mercantile Exchange futures prices. You can easily predict a quoted price by adding the 3 months prices in the settle column and dividing the total by 3. In this case, you would be locking in 95% of $16.25 or $15.44. This sets the floor price for your guaranteed revenue. You cannot purchase a quarterly endorsement if any of the 3 months closing price is limit up or limit down. Limit up or down is defined as a 75-cent increase or decrease from the previous day's close. As you can see on this slide, in the change column, the prices did not reach limit up or down, thus a quote was available on this trading day. I encourage producers to consider purchasing endorsements on trading days when the change price approaches but does not reach limit up for any of the 3 months comprising a quarter. You are also prohibited from purchasing endorsements on the days when the price, production, and/or cold storage reports are released. To determine a loss or indemnity, you compare the quarterly quote price or floor we discussed on the previous slide to the simple average of the corresponding 3 monthly prices published by the Agriculture Marketing Service. Remember, you are insuring your milk over a 3-month quarter. This chart here, which you saw on Nate's presentation, illustrates the quarterly volatility experienced by the Class 3 and Class 4 milk market prices dating back to the first quarter of 2006. The dotted lines represent price trend lines. Red is Class 3, blue is Class 4. These trends are based on large data sets with volatile peaks and valleys like we have experienced during the past 15 years. Through the first quarter of 2020, actual Class 3 prices are trending towards $15, and Class 4 is trending towards $14. Obviously, COVID-19 has had a dramatic impact on recent markets. We hope these trends are wrong, as prices have actually rebounded over the last month, as Nate also stated. DRP allows us to, at best, lock in a profit, or at worst, minimize our losses. This graph illustrates how actual Class 3 and Class 4 milk prices constantly cross each other's paths. I believe this necessitates the need to insure both classes of milk for the same quarter as a method of leveraging your opportunity while also mitigating price risk. Like other forms of government-subsidized crop insurance, DRP insurance is designed actuarially to pay an indemnity equal to gross premium paid. which equates to a 100% expected loss ratio. Gross premium is defined as producer premium plus the subsidized premium. Thus, DRP is designed to pay indemnities greater than the producer paid premiums. DRP is designed to make you whole, not rich. It should help you through a tough quarter or two, like the graph on the previous page illustrates, until prices hopefully turn higher. Whereas I agree with this concept, I am driven to leverage this product to the utmost financial benefit of my customers. I view the subsidized producer premiums and guaranteed revenue as a sound investment. Simply put, the premium subsidies currently in place make this a very valuable risk management tool. Here I want to reiterate the fundamental concept of establishing expected guaranteed revenue while introducing a premium quote as well as the expected yield component. The expected yield is based on the expected pounds of milk produced per day per cow based on a state or pooled region average. It is not based on the individual insured's actual production. Expected yield will be compared to actual yield, as I will illustrate in a moment, to determine payments in the event of an indemnity claim. In this scenario, we lock in a floor price of $15.20 per hundredweight, which is 95% of the settlement price of $16 per hundredweight on the Chicago Mercantile Exchange. The guaranteed revenue for this endorsement would be $1,520,000 based on 10 million pounds of insured milk. In this case, we would pay a premium of $36,277 or 36 cents per hundredweight for this coverage, which is 56% of the gross premium. The premium subsidy makes this a very inexpensive and valuable put, in my opinion. The ending or actual yield is determined by the National Agriculture Statistics Service. Actual yield is calculated by multiplying actual milk produced per cow per day multiplied times the number of days in the quarter to be insured. The actual yield will then be compared to the expected yield to determine the adjustment to actual revenue. Remember, DRP is an area-based revenue plan. Fluctuations in price and yield determine if and/or how much loss is incurred. Remember though, historically, price plays a bigger factor than yield for this particular plan of insurance. Here we explain the formula for calculating indemnity. Stick with me here. We assume the following: 10 million pounds of milk insured for the quarter, 5,965 pounds of expected, and 5,965 pounds of actual milk produced per cow per quarter. An expected class price of $16 per hundredweight, which equates to a trigger price of $15.20 per hundredweight. And finally, an actual class price of $14 per hundredweight was experienced. This would generate a $120,000 indemnity payment as we subtract actual revenue of $1,400,000 from expected guaranteed revenue of $1,520,000. As mentioned previously, price drives this plan more than yield because prices are generally more volatile than yield. However, an increase in actual state or pooled region yield would increase the production per cow factor, causing decreased indemnities. Conversely, a reduction in actual yield would decrease the production per cow factor, causing increased indemnities. Producer premiums are due 25 days after the last month of the quarter for which milk is insured if there is no loss or indemnity. In the event of an indemnity, premiums would be deducted from the loss payment. Okay, here's where I get excited. Again, there's a lot of numbers here, but this is what it's about. I believe the math illustrates the benefit and value of DRP. How might this plan perform in the next 4 quarters if we experience prices we actually experienced from 2006 to present? This is the method I designed to evaluate endorsement choices based on daily quotes compared to how the policy would have performed in the past. For instructional purposes, I do not include the yield or milk per cow factor in this equation. So, if you had insured 10 million pounds on the effective date of May 18, 2020, what would the indemnities have been using the past 15 years actual quarterly price compared to the quoted price you purchased on an endorsement? Please focus on the 2021 Q1 January through March interval at the top left. Second row down, highlighted in gray. Move to the right 2 columns to the red Class 3 quoted price of $15.95. You are guaranteed 95% of $15.95 or $15.15. Please move to the right 2 more columns to the Class 3 premium. You would pay 33 cents per hundredweight times 10 million pounds, which equals $33,000 in premium. Now move to the left side of the table to the Q1 and indemnity columns to the right of the year column. The historical Q1 actual price was lower than the guaranteed quoted price of $15.15 in 7 of those 15 years. This would have resulted in indemnity payments of $1,360,417 versus a premium paid of $495,000, which is simply $33,000 in quarterly premiums times 15 years. This equates to a 275% loss ratio. Again, not all quarters are this lucrative. As opportunities present themselves in the future, you are able to layer additional coverage on top of previously endorsed coverage based on personalized pre-planned price alerts and individual unique strategy. There's no way of predicting future prices, and there are no guarantees of achieving loss ratios over 100%. However, it is important to devise a plan and stick with it. I don't think this math lies. It's also important to understand that DRP only covers the difference between expected revenue compared to actual revenue. No other perils are covered. If there is a loss, the producer is automatically notified by the insurance company, and then they are required to fill out a simple worksheet documenting total production for the quarter insured, as well as providing proof of production from their milk handler. Not all crop insurance agencies nor all approved insurance providers offer DRP. You must complete an application annually. You are obligated to that agency and that approved insurance provider for all endorsements during the 1-year time period starting July 1st and ending the following year on June 30th. The URLs listed on this slide are great resources for researching the value and benefits of DRP. The first URL directs you to a basic fact sheet which explains the fundamental details of DRP. The second is a browser illustrating actuarial information like expected revenue, expected yield, actual yield, etc. This information is state and county specific. The third URL is an actual cost estimator for those producers wishing to run individualized quotes to determine unique premiums and revenue guarantees. It's been my pleasure to share my knowledge of dairy revenue protection with you today. I hope you have a better understanding of the benefits and value of DRP and urge you to explore how this risk management tool can benefit your unique dairy operation. Please contact me by phone or email if you have any questions. I would be happy to help you any way I can. Thank you, and back to you, Matt.
Wow, thanks, Sterling. We appreciate the introduction to dairy revenue protection this morning. We've seen a lot of producers take advantage of this powerful tool to help manage price risk on their farms. Well, I want to thank both of our speakers, Sterling and Nate, for joining us and sharing your individual expertise and insights. I want to thank all of our customers and team members, industry advocates, supporters, for carving out time today. We know your time is valuable, and we appreciate you joining us, and we hope you found value in the information that we shared this morning. If you have additional questions, we encourage you to reach out to your friends here at Farm Credit Mid-America. It's been a pleasure to host you all this morning. I want to wish you all best wishes, and we hope to speak with you soon. Thanks again for joining us. Have a great day.